So, Bob, the Buffett indicator is now over 200%. The value of all publicly traded stocks to GDP, it's over 200%. It's the highest on record, I think. The mean is about 70%. Are we in a melt up stage or about to enter a melt up stage, or are you expecting a mean reversion downward to that 70% area?
Well, the general dynamic here of over easy monetary policy, it does favor stocks relative to bonds, and in part because bonds are a soft asset and stocks in some ways are a hard asset, right? If you've got to go out there and find something that will maintain its value during the risk of a higher inflationary environment, companies in part benefit from higher inflation because it means that revenues are higher, and as a result, nominal profits are higher. And so I think what we're seeing, that unusual combination of gold performing very well and stocks performing very well. In fact, I was just looking, this is the only time in history where gold is up 25% in a calendar year and stocks are up 25% in a calendar year. I mean, so it gives you a sense of how unusual what we're experiencing right now is. And so I think that's very indicative of this sort of environment where money is running too easy, and so you can have a circumstance where people are essentially moving out of huge bond portfolios, trying to find something that will maintain a storehold of wealth over time, and so you get a squeeze up in both stocks and gold.
So it sounds like bonds are the loser, and while stocks and gold still win. So the three largest companies in the S&P, Apple, Nvidia, and Microsoft, they make up over 20% of the index. The concentrated risk is at a record high. It far out surpasses the highs in the early 80s, which I think by more than 53%, the late 1990s by more than 67%, and 2008 by more than 100%. So the concentration at the top is unparalleled. What is the risk that markets are facing as it stares down the biggest concentration bubble in history at the top of the equity pecking order here?
Yeah, what really creates a lot of idiosyncratic risk when you're buying the S&P 500, which I think most people think I'm buying the S&P 500. It's a diverse set of stocks. It'll mostly move with the U.S. economy. And certainly a lot of passive investing is going into those assets. And essentially passive investing is simply momentum investing, right? Because you're just buying, the biggest stocks and you're chasing which stocks have gone up recently. And of course, momentum investing is often, can be a good strategy until it is not. And in this circumstance, I think what we see is a lot of idiosyncratic risk. I mean, just take NVIDIA in particular. You could easily have circumstances where, say, a regulatory constraint on the ability to sell chips into China, which is not something that is necessarily what people think that they're betting on when they're buying the S&P 500. Just that could be, a meaningful influence on NVIDIA's stock price, and then on top of it, could create a meaningful hit to the S&P 500. Or, say Microsoft runs into some challenges with the Department of Justice and, antitrust and issues like that. There's lots of different.
Isn't NVIDIA kind of facing that right now?
Yeah, I mean, NVIDIA is also facing it related to national security issues and matters like that. The point is that, who knows whether any one particular one of these things will play out as being a drag on those particular companies. What it highlights is that you as a stock investor, as a common stock investor, essentially are significantly levered to those couple companies and the prospective risks that exist with those couple companies. And part of the idea of investing in stocks is to hold a diversified basket, because you don't know, is Pepsi going to win or Coke going to win, right? Like that's, as an investor, as a common man investor, like who knows, right? You don't want to really bet on that. You just, people will buy soda just as they're buying everything else. And so people who are buying the S&P 500 right now have a huge implicit bet on these high flying companies.
Yeah, and I think the average investor, to your point, would like to see gains in their portfolio while having little to no risk at all.
That's right. And the further concentration you get, just almost by definition, the greater risk that you're going to experience in a portfolio. And so that's, that has created greater and greater concentration risk in the S&P 500 and likely higher volatility ahead relative to the returns that people are going to see.
Definitely something everybody should be paying attention to.